Hey Bowtie Nation, Joseph Hogue here with one of the most important videos I've done in a while. That's because investors are loving the leveraged ETFs, pouring $137 billion into these funds last year, an increase of 46% from the year before. And with $20 billion of that into single stock ETFs, that is 11 times the amount invested just 1 year ago. And I get it. What's not to like about getting 2 or 3 times the return on stocks like Nvidia and Tesla, leveraging your returns into those triple-digit payoffs? But as these leveraged investments get more complicated, so do the risks and the hidden traps for your money. In fact, the way most investors are using these leveraged ETFs is a guaranteed way to lose money. Holding the Ultra Pro QQQ ETF, a 3x leverage on the NASDAQ index, would have made just 1% over the last 3 years, while just holding the index would have made over 30% over that period. I'll explain leveraged exchange-traded funds, how they work, and 3 strategies you can use in single stock ETFs to boost your returns and reduce risk. I'll then reveal 5 single stock and leveraged ETFs to watch for your portfolio. Normally an ETF holds a group of stocks, then sells shares in that group, making it an easy one-stop investment instead of having to buy all the stocks separately. For example, that Invesco QQQ Trust holds shares of the 100 largest non-financial companies on the NASDAQ, all your tech heavyweights like Apple, Nvidia, Microsoft, and Amazon. So ETFs are a great way to invest, giving you that instant diversification for lower risk as well as the upside to major themes in the market. Leveraged ETFs go a step further though. They might hold the stocks in the group as well, but the strategy is based on using derivatives like swaps, options, and futures to magnify those returns. For example, that ProShares Ultra QQQ targets a return of 3 times the daily performance of the QQQ by investing in swaps on the index along with treasuries and holding some of the shares. Now, those swaps are a contract between the ETF and a bank agreeing to swap out the return on that asset, in this case the index fund, against a fixed or a floating rate. So the leveraged ETF really doesn't even have to own these stocks here. They get that 2 or 3x return and pay an interest rate on the contract to the bank. But this is going to set up for 2 very important risks that we'll see later. And this is how most of the single stock ETFs work as well. For example, to produce that 2x daily return on shares of Supermicrocomputer, ticker SMCI, GraniteShares uses swap contracts on the stock. That's an investment that paid off on Monday with shares of SMCI up 10.3% and the single stock ETF jumping by 20% midday. So these 2 and even 3x returns do happen, and I'll share 3 strategies for using these leveraged ETFs that you need to see, but many investors are using these all wrong, not understanding the risks and how the return can fall apart over time. I want to get into those 5 leveraged ETFs, starting with the GraniteShares Yield Boost Tesla ETF, ticker TSYY, but stick around for those 2 risks to these kinds of investments. Now, I want to be fully transparent here. This video is sponsored by GraniteShares. I joined the firm last month in New York for the NASDAQ closing bell ceremony and to talk about my 2025 market outlook. I will be talking about a few GraniteShare ETFs in this video, and I like its strategy of that daily rebalancing to minimize the tracking error that we see in other leveraged ETFs, but make sure you do your research before buying any of these funds and focus on the 3 strategies I'll show you later. That Tesla Yield Boost is different from the other leveraged ETFs we'll cover in that its primary objective is income rather than return. It's using swaps to get that 2x return on shares of Tesla just as with these other ETFs. But here it's doing so to fund that monthly dividend. Next on our list, the largest leveraged ETF at $25 billion in assets is the ProShares Ultra Pro QQQ, that 3x fund on the stocks in the NASDAQ 100 index. And you get a sense of the potential, but also one of the risks here in this 1-year chart. Here we see the TQQQ ETF has jumped 88% over the last year, not 3 times the 37% return on the NASDAQ QQQ index, but still a return any investor would be happy with. But here, if you look at those periods where stocks fell, so in April and July of last year, you see how fast those returns can evaporate in the leveraged fund. When the QQQ lost just under 7% in April, the leveraged ETF plunged 20%. And when the NASDAQ fell 13% in that July to August correction, shares of the TQQQ plunged 37% on the month. Tech stocks like Nvidia, Tesla, and Microsoft have led the market higher, and there's nothing to say that they won't produce those kind of returns going forward, taking that leveraged ETF higher with them. But there are 2 risks here that you need to understand before I highlight those next 3 ETFs. First here is an operational risk around how these ETFs are managed. Now, portfolio managers have to adjust those ETFs every day to keep that leverage, and it can cause a lot of problems. For example, in November, with assets to his 2x long MSTR ETF booming to over $3 billion, the portfolio manager couldn't get enough swap contracts to keep up that leverage. He was forced to use options instead, which are more costly, and meant the actual return was off from that 2x potential. That operational risk is a smaller problem though compared to the tracking error in these leveraged ETFs over longer periods. And this tracking error is why you see differences between those leveraged funds and their indexes or the single stocks and is the biggest mistake investors can make here. GraniteShares does a good job of explaining why this is in its FAQ page, which I'll link to in the description below. It's largely a function of volatility and the difference between an arithmetic and a geometric mean, which I know is a sentence only numbers nerds like myself can love, but you can see it here played out in this chart. If a stock is trending in one direction, say it goes up or down 3% on 2 consecutive days, the difference in that fund's 2x objective and what it should produce is minimal. Here, without compounding, a 2x leveraged ETF should be up about 12.18% over the 2 days or down 11.8%. Now, the actual results would only be about 0.1% off, so that's not too bad, but then that's only 2 days. Holding the ETF for months is going to see that difference compounded even in a one-way market, but it's even worse in a volatile up and down market. When a stock rises one day and falls the next, that difference between what a leveraged fund should have done and the actual results is going to be much bigger. And despite firms making this clear that the return on these leveraged funds will not hold up over those longer periods more than a day, investors are using them as a buy and hold investment. But then there are 3 strategies that you can use to take advantage of these leveraged and the single stock ETFs. 3 ways to get those 2 and 3x returns. And first here is investing around a specific event, like earnings, a product announcement, or some other expected news. We're just coming into fourth quarter earnings and could see some big moves in stocks as they report their profits. Shares of Nvidia jumped 16% on its fourth quarter report last year, posting revenue that surged 265% for those 3 months. But then investors trading the event and shares of the 2x long Nvidia ETF, the NVDL, saw the fund increase 32% on that day. Another strategy to use these leveraged ETFs is for hedging to lower your risk in a single stock or an index. The stocks can fall on a disappointing earnings or product announcement just as well as they can rise. Shares of Nvidia were under pressure even before its third quarter earnings as expectations just got too high, and the stock slumped nearly 20% in the week following the report. But putting on a short-term buy of the 2x short Nvidia ETF, the NVD, could have completely reduced your downside risk. A third strategy here is to amplify momentum in the market or for a specific stock. Stocks clearly had that upside momentum following the election last year, with the Nasdaq QQQ index up almost 5% over the week, but an investor could have rode that to a 14% return in this 3x leveraged ETF. So avoiding those risks and really getting the most out of these leveraged ETFs and the single stock funds means taking a short-term focus, thinking through a narrative of where a stock is going to be over the next day or week and why, then taking a position to magnify that return. It's not for long-term buy and hold investors, but can be an important tool you can use. Another leveraged ETF to watch here, the Direxion Daily Semiconductor Bull, ticker SOXL, with its target for 3x returns on the semiconductor index. Here's another example of that risk though, with the fund up just 27% over the last year, only performing in line with the semiconductor SOXX ETF, but it does make that 3x return on a daily basis. AI demand for semiconductors is not slowing down, and stocks like Nvidia, AMD, and Broadcom will continue to move the markets. That SOXL leveraged ETF could be a good trade on days before earnings for those major companies, or conferences like the recent Consumer Electronics Show. I'm up just over $131,000 on shares of Supermicrocomputer, ticker SMCI, for a long-term hold, but there might also be an opportunity near-term here in this 2x SMCI daily ETF, the SMCL, up 20% last Monday. The company has until February 25th to file its late reports and avoid being delisted by the Nasdaq exchange. An independent analysis found no wrongdoing in the accounting, and the firm has found a new auditor, but it's still going to take time to put those reports together and file them. It should have plenty of time, and when it does though, those shares could jump even more than Monday's 10% gain on this underlying stock. We still got one more leveraged single stock ETF, an ETF on one of my favorite stocks with a profit of almost $73,000 over the last year. But for those long-term investors out there looking for the ETFs you can buy and hold, make sure you check out this video here in the corner, the 10 best ETFs to buy for 2025 and beyond. Shares of Alibaba, ticker BABA, have been extremely volatile, not just on company news, but around stimulus measures in China and the potential policy changes here in the US. I've made almost $73,000 on the stock and a bull option spread and continue to like the shares on valuation. But another way to get exposure here is through the 2x long BABA daily ETF, ticker BABX. Remember, like any of these leveraged funds, this is not a buy and hold investment, but a tool to take advantage of those near-term price changes around events or news. Alibaba is set to report earnings on the first week of February, and we could see more economic stimulus announced in the country shortly after President Trump's inauguration as a way to offset maybe potential tariffs. Click on the video to the right to see those 10 ETFs to buy for 2025, 10 exchange-traded funds in the biggest growth themes this year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.